Back to oil, though, commodity strategists are weighing in on the direction it could go as these recessionary fears and geopolitical uncertainty continue to mount. One call from Citigroup is getting attention today, cautioning that WTI could fall to $65 a barrel. Meanwhile, though, JP Morgan said last week that oil could rocket upwards to $380 a barrel. Well, joining me now for a Canadian perspective and to figure out where we land in all of this is Randy Ollenberger, Managing Director of Oil and Gas Equity Research at BMO Capital Markets. Thanks for joining us, Randy.
My pleasure.
So let's start with what's happening today. This, is a pretty significant drop we were just looking at, down, nearly 9% right now. What do you see as the driving force behind this, this massive drop?
Yeah, I mean, pretty clearly the oil market's pricing in a recession. So, you were commenting that, the odds makers, if you will, are putting a lower risk on a recession maybe than the oil market is. But the oil market definitely is pricing in a recession, in our opinion. We felt there was probably about $20 of downside risk as the market began to price in a recession. So, we started at 110, we're down to about $100, call it plus or minus. There's probably another $10 of downside risk. If we're looking at a severe, deep recession, maybe a little bit more than that, but I certainly wouldn't be going as low as 65.
Okay, so that's too far, the Citigroup call. But I mean, another $10. Now, could that be, happening soon? If markets need to price this sort of risk in?
Well, we need to see some data points here. There's no data points here that really support that yet. So this is really speculation that we're going to start to see some of that evidence that indicates we are already in a recession or that a recession is imminent. Because if we look at the demand statistics right now, the inventory statistics, the oil market fundamentals, they don't really support the view that oil should be dropping here. So I think, oil probably will pause here a little bit. I don't really see a lot of more downside risk until we start to see some firm data indicating that demand is really going to get hit hard here. If we're only looking at about a 2 million barrel a day drop in global oil demand, I don't think that's enough to take the oil market a heck of a lot lower.
What about the upside risk here that JP Morgan was outlining? So, there's the conversation that's, ongoing about the potential for a price cap on Russian energy exports. And then, the possibility that maybe Russia retaliates if that were to, come to fruition. What is your sense of what that could do to the price of oil?
Yeah, I mean, I really do think there's more upside risk here than downside risk. As I said, maybe $10 of downside risk. I think the upside risk is much bigger than that. We are still looking at a lot of shortages. The reality is, we can't see any demand growth in North America or Europe because we have to shrink demand enough there to allow for demand growth in the non-OECD, China in particular. If we start to see some evidence of demand growth in the United States, we're really going to start to put some pressure on the market because there's just not enough oil, there's not enough products, there's not enough refining capacity, and really we're just short energy across the spectrum here. So we really do believe there's more upside risk than downside risk here, even with a recession scenario.
Really? Okay, so I mean, at the end of the year, where do you think oil is?
Well, certainly higher than it is today. I mean, I think we're probably looking at oil prices, moving higher over the next several months here, depending on, what the recession actually looks like. But if it's a moderate sort to mild recession, kind of in line with what we've seen historically, which is about a 2% impact on demand for a couple of quarters, we would expect to see oil prices moving back towards that 130 level.
Okay. So what does all of this mean then for energy companies? Because we were looking at just a couple of them seeming to be, reacting, shares reacting along with, the drop in the price of oil. What do you see for the, the future for the energy sector in Canada?
Yeah, I mean, obviously the oil stocks here are very highly correlated with oil prices. And so we really are sort of trading off one for one, if you will, with the oil price. We've got the second quarter results coming up here right away. It'll be a bit mixed. There was a lot of maintenance in the quarter, some cost inflation. So we're also seeing some of the numbers and expectations coming down. So that's probably playing into some of the sell-off a little bit here in advance of the quarterly results. But overall, the numbers are really good. The cash flow is really high here. Debt levels are coming down more quickly than expected. And it's really putting companies in a position here to accelerate cash returns to shareholders. So we see tremendous value in the group here. And with the sell-off today, we would argue that the group's probably discounting an oil price below the $60 level.
Okay. Well, what's the biggest risk then for the sector going forward?
Well, the biggest risk here is just really, kind of the perceptual one around the recession risk in the near term here and how that influences oil prices. But, if what happens if oil prices start to move higher again over the second half of the year here, we would expect the stocks to continue to move higher. And as these companies accelerate their cash returns to shareholders and, in fact, give checks to shareholders in the forms of dividends, special dividends, variable dividends, and so forth, we really do see that as driving additional share price appreciation for a lot of these names.
I wonder if I could get your perspective on the investment in the sector as well, because out of the Bank of Canada Business Outlook survey that we've been focusing on this week as well, it said that firms say that capital spending growth in the sector will be modest over the medium term, and that only about 40% of estimated cash flow is being allocated to capital investment this year, noting that this is less than in previous commodity booms. What do you make of the investment that is happening or planned to be happening?
Yeah, I mean, this is a sector that normally spent all of its cash flow and then some, and we're now in a situation where, as you say, they're spending less than half of their cash flow. There's a lot of factors behind that. One is just simply investors, shareholders, they want their money back. And so these companies have a fiduciary responsibility to respond to what their shareholders are demanding. But the other here in Canada really is we don't have the pipeline capacity to produce anymore. So really, what's the point of investing in more productive capacity if you can't move it out of the country?